I can see we have some attendees joining at this point. We're going to give everybody about 30 to 45 more seconds to get in here, get situated before we begin our next session with Cority and Trinity Consultants. So thank you again for being a part of the event. Great feedback so far. Really enjoying connecting with different people at the event on LinkedIn already. So it's really been a great event, and we appreciate you being here for it. Okay, well, I know we're going to have some more people joining us as the next few minutes tick by, but I don't want to take up any time that we have with Bill and Christi. So we have Bill Palmer, he is with Cority, and then Christi Wilson, she is joining us and joining Bill from Trinity Consultants. So they are going to talk to you guys about GHG, what's it going to cost you? Focusing on the Inflation Reduction Act's new Methane Emissions Reduction Program. And according to Christi, the EPA just came out with about a 700, was that 700 page that I walked into the conversation before update. So I am going to turn this over to Bill and Christi now, and thank you both for being a part of the Environment and Energy Leader Solutions Summit.
Great, thank you, Jessica, I appreciate it. Good morning, everyone, and thank you for joining us today. My name is Bill Palmer, and I'm a product marketing manager with Cority, and I'm delighted to serve as your moderator for today's webinar. Today's topic couldn't be more relevant or timely. We're going to deep dive into the environmental regulatory landscape and discuss the critical role of sustainability and compliance in the industrial sector. Our guest today is Christi Wilson, and she's a renowned expert in this field. She has a wealth of knowledge and experience gained from over a decade of working with Trinity Consultants. With a focus of oil, natural gas, iron, steel sectors, Christi has been actively engaged in greenhouse gas quantification and reporting efforts for these and other energy-intensive sectors since the inception of EPA's greenhouse gas reporting program. So in our discussion today, we'll unravel the complex intricacies of the Inflation Reduction Act and its profound impact on the industry. We'll also explore how the Methane Emission Reduction Program, or MERP for short, you know, us EHS professionals, we like our acronyms. So, but we're going to discuss how that fits into the broader landscape of greenhouse gas emission reduction initiatives and the unique challenges that it presents. We'll also delve into the specifics of reporting requirements, thresholds, and deadlines, and offer practical advice on how organizations can effectively navigate these complexities and ensure compliance. But more than this, we hope to provide you with the tools and understanding you need to make informed decisions in your own organizations and to recognize the opportunities that lie within these regulatory challenges. As always, we encourage you to actively participate in the discussion by sending in your questions as they come to mind using the Q&A function in Zoom. There'll be a dedicated Q&A segment toward the end of the webinar where we'll try to address as many questions as we can. And if we don't get to all the questions during the allotted time, we will reach out to you shortly after the webinar. So once again, we appreciate your presence here today. So without further ado, let's dive right in and welcome Christi Wilson with Trinity Consultants.
Thanks, Bill.
Okay. So Christi, could you share with us your journey in the environmental space and how you've transitioned into a sustainability role at Trinity Consultants?
Sure. So you kind of touched on a little bit on my background. I spent about 10 years working directly in the industrial sector right out of college, managing environmental compliance programs for refining and chemicals in particular, and was actually a client of Trinity's, which is kind of how I got to know the Trinity folks really well. So joined the Trinity ranks about 17 years ago, and really with the idea that I would be helping to build the business, particularly in Pennsylvania, where I'm located, as we were expanding our services geographically. Trinity's been, in the environmental space with a heavy focus on air quality for more than 40 years now. And so we've kind of built our reputation in that space. And so, leveraging that sort of technical expertise in the air quality realm into serving clients with their GHG needs as EPA rolled out the greenhouse gas reporting program. That was just sort of a natural transition, kind of a natural fit for us and the services that we offer. And then kind of over time, that's really expanded to supporting clients with their overall sustainability journey. So not just collecting data and calculating their footprints, but really focusing on strategy and mitigation work and trying to understand where they can take steps to minimize or reduce their emissions in the greenhouse gas space. And then really that's just been kind of a natural growth from the work that I've been doing in those sectors, like you mentioned, that are really energy intensive and hard to abate. And then earlier this year, I really transitioned into a role as manager of sustainability services with Trinity, again, to focus exclusively on this sustainability piece and really helping clients make the transition from their traditional environmental compliance work into how that fits into the overall sustainability piece of the puzzle. So that's kind of how I landed where I am.
Wow, what a journey you've had. It's enlightening to hear about your evolution in this ever-changing field. So given your deep experience, I think we can dive straight into some more intricate parts of our topic. One area that's generated a lot of discussion is the Inflation Reduction Act. So could you provide a more comprehensive explanation of the Inflation Reduction Act and how this methane waste charge will impact organizations within the industry? And what are some of the primary challenges organizations might encounter in light of this new regulation?
Yeah, sure. So the Inflation Reduction Act is really a piece or a distilled version, I would say, of Biden's Build Back Better plan. And it's meant to focus on a number of initiatives that are really focused on tackling climate issues as well as some social issues. So it's a pretty broad reach and touches a lot of different programs, everything from healthcare and prescription costs to investments in clean energy. There's a corporate tax rate provision within the act. So there's a whole bunch of moving parts here, as these things tend to happen in Washington. But the one provision that we've been focused on kind of from the more traditional environmental compliance focus area is the piece that affects the oil and gas sector, which is the Methane Emission Reduction Program that you mentioned at the top. So this MERP is really meant to establish a charge or a tax, if you want to call it that, on waste emissions of methane from this sector specifically. So under the act, MERP establishes kind of a threshold or an allowance, I would call it, for each segment of the oil and gas sector. And basically any emissions that companies emit above that threshold would be subject to the tax. And in this case, because EPA will administer this program, not the IRS, they are calling it a methane charge or a fee and not a tax. So I'm sure some lawyer can explain the implications of that, but that is something that EPA has been very clear to say that this is a methane charge and not a tax. So there are a number of challenges that we're expecting folks to be wrestling with as they try to navigate this. The first and probably most compelling one that Jess alluded to earlier is that EPA has been working on some proposed changes to their greenhouse gas reporting program, in particular subpart W of that program, which is the subpart that the oil and gas sector reports under. So we saw a group of proposed changes to that rule last summer in June of 2022. EPA drafted those before the IRA was actually finalized. And so they have now gone back and revisited those proposed changes and made some pretty wide sweeping revisions to them. And just last week, we've seen now a pre-publication version of those proposed changes. So nearly 700 pages of updates and changes to subpart W that will change a whole host of things in terms of how companies are calculating and reporting emissions under that program. So that will be a challenge for folks to navigate, get their heads kind of wrapped around the implications of that. It does introduce new sources that will need to be captured, new calculation methodologies and techniques, new monitoring requirements, And so it is a focus more on empirical data. So this was one of the mandates of the Act, was that EPA would need to go back and revisit Subpart W to ensure that the requirements were based as much on empirical site-specific measured data as possible. So, so based on those changes, a lot of companies have historically relied upon industry average emission factors or default emission factors that EPA has written into the rule. They may now need to go back and revisit that approach and change the way they've been calculating their emissions. So it's both an opportunity and a challenge in that sense, because the proposal does allow for companies to use empirical data where they have it in lieu of those factors. So in many cases, the factors are very conservative and might be overestimating emissions for some companies. And so the ability to use empirical site-specific data where they have it could actually work in their favor. And so that's one of the things we'll certainly be encouraging our clients to look at, evaluating the implications of those changes for their specific operations and really trying to understand, what that means for them. So those are some of the more technical challenges, I would say, in terms of the calculation aspects of the rules and what the tax might be based on. Then there are more what I'll call administrative logistics type of challenges that we're anxious to see how EPA will roll out. And so these proposed Subpart W changes that just came out last week really only focus on one piece of EPA's obligation under IRA. The other piece is how they will actually administer the program. So there are two really key aspects that we are anxious to see. One is there is currently an exemption provision within the Act that allows companies who are subject to and in compliance with the new source performance standards, they would be exempt from the waste fee. And so we're anxious to see how that is going to play out in terms of what regulatory language EPA crafts around that, and what criteria will be established for compliance, and kind of what that's going to look like. The other piece is really related to there's a netting provision that's written into the rule or into the Act that says that companies can net across their operations to determine their obligations under the waste fee calculation. So again, we're anxious to see how that will actually be administered and what that language will look like, since it's not quite clear exactly what the criteria will be around that provision as well.
Okay, great. Thank you for that in-depth explanation. That was great. It seems like the implications for the IRA are definitely complex and far-reaching for the industry. You mentioned that companies will need to accurately track their activity data. So let's quickly take a poll to see how people are currently tracking their air emissions. Okay. We'll give you 30 seconds or so to complete the poll. Okay, still got some answers coming in. We'll give about 15 more seconds. Okay, we'll go ahead and end the poll there. Thank you very much for that. Okay, so I'm curious to learn how this fits into the broader climate strategy. So how does the Methane Emissions Reduction Program fit into the broader landscape of greenhouse gas emission reduction initiatives, and what makes it unique?
Yeah, so the Biden administration, as probably most folks know, with the Paris Agreement, has committed to reducing U.S. greenhouse gas emissions, has committed to cutting those in half by 2030. Okay, so it's a pretty ambitious goal. I've seen a number of different folks weighing in on the impacts of the IRA and how much progress we can get, or how much mileage we can sort of get out of that program toward that goal. And I've seen numbers as high as 40%. So I do think that this is a key piece of the administration's overarching strategy for reducing the country's GHG emissions impact. So that's pretty important, right? And why it's sort of a landmark legislation in that sense. I think the other aspect of this that makes it somewhat unique is it's the first rule that we're seeing that does impose a carbon tax at the federal level. So there are a number of states with initiatives that are currently in place or being proposed. This is the first one we're seeing at the federal level, and it interacts very closely and intentionally with these new source performance standards. So we have regulatory compliance framework as well that's intertwined with this. And so there's some thought that was strategic on the part of the administration in terms of tying compliance with those federal rules in with your liabilities under the act, so that if you are in compliance with the rule, then you are exempt from the act, that it's further incentive for companies to sort of get on the bandwagon with that regulatory framework and perhaps reduce some of the opposition to that rulemaking. So, over the last decade in particular, there's just been an exorbitant amount of legislation, of rulemaking, and a lot of back and forth with the EPA over new rules, particularly for this sector. So it's interesting to kind of look at it from that perspective, that this may be one way of trying to get the industry to really buy into these new rules in a way that gets them, making headway sooner.
Great. Yeah, it's definitely clear that the MERP is going to be a major tool in fighting climate change. And I think what's important is the distinctiveness of it being the first carbon price on greenhouse gas emissions is definitely something to note. So, but there's also a lot of detail on the reporting side of this program. So could you walk us through the reporting requirements, thresholds, and deadlines associated with the MERP, and how organizations can effectively navigate these requirements and ensure compliance?
Sure. So as I mentioned before, EPA will administer this program. And so the thought is that the emissions data that you report through the existing greenhouse gas reporting program framework will be the vehicle for folks to submit their information and for EPA to actually calculate and levy the waste fee or the charge based on those emissions. So the applicability for MERP is tied directly to that greenhouse gas reporting program, meaning facilities with actual emissions over 25,000 metric tons per year on a CO2e basis would be subject to the MERP, just like they are subject to EPA's reporting program. So that's kind of your threshold to get into the program. Annual reports under that program are due March 31st each year. We would expect that to remain the same, no changes there. And then the sort of allowable thresholds for MERP are established based on which segment of the industry you're in. So the thresholds are different for production, non-production, and transmission sectors. The distribution segment of the industry is not subject to the tax. So I think that's an important thing to point out. And so the waste threshold for upstream production is 0.2%, and that is the amount of methane you emit per the amount of gas you send to sales or product you send to sales. And so that's how that's calculated. So 0.2% for upstream production, 0.05% for non-production facilities, and then 0.11% for transmission. And so that's kind of your allowance threshold. You would be taxed on any methane emissions above that. And that's the portion that would be subject to the tax. That kicks in with the first fee would be due in 2025 for your 2024 emissions. And the tax rate starts at $900 per ton of methane in 2024, and then increases to $1,200 per ton in 2025 and $1,500 per ton for 2026 and beyond. So there are a number of additional regulatory changes. I mentioned this suite of Subpart W changes that we saw just last week that could impact your liabilities under MERP. So I think the biggest concern we have for folks is that many people are focusing on assessing their liabilities by looking at what they've been reporting up to this point historically. So EPA's greenhouse gas reporting program has been in place since 2010, 2009, so a long time. And folks have, most folks have a deep history of reports that they can look back on. And so we just want to make sure that folks understand that that would be short-sighted to assess your liabilities strictly based on what you've reported in the past. So we've got these new rules that have been proposed in the last week that would certainly change the actual emissions that most companies would be reporting, because some of the things EPA has done here is they've filled some gaps in sources that have not historically been subject to reporting, but now will be. So that includes things like what we refer to as super emitters, so large unplanned events like blowdowns or blowouts and things of that nature now have to be quantified and reported. Nitrogen removal units, produced water tanks, and crankcase venting from engines. There is a pretty substantial change in the methane slip emission factor that's being proposed that will impact a lot of companies' footprints. And so understanding the implications of those proposed changes on what your actual emissions may be that you're going to be reporting going forward is going to be a particular importance and can also be challenging. I think the other thing worth noting is EPA also proposed another suite of changes to Part 98 earlier this spring that not specific to Subpart W, but specific to some other aspects of Part 98. And one of those includes a change in the global warming potential for methane. So we have been running a little bit behind the rest of the world in terms of the latest science, and methane global warming potentials under EPA's program have remained at 25 times more potent than CO2. And now this will update that to 28 times. So with no changes at a facility year over year, their emissions are going to increase just simply because of these proposed changes. And so I think it's important for folks to really be cognizant of that and make sure that they're taking that into consideration as they're looking at their potential liabilities.
Great. Well, thank you for breaking down the reporting requirements and thresholds. It definitely seems like organizations have a lot to keep track of to ensure compliance, but that brings us to another point, the guidance around this regulation from the EPA. What types of things should we be looking at or looking for as EPA paints some guidance around this regulation? From where I see it, there's three kind of loose ends related to how the two aspects of the program could work into a company's favor. So one would be the netting provisions that you spoke about earlier, which would allow them to net their fees that they would pay. Two would be the exemption for facilities subject to and in compliance with NSPS Quad OB. And then three would be changes to 40 CFR Part 98 that are changing the way people are calculating emissions.
Yep, I think those are the key issues at hand. We've talked about the Part 98 proposed changes, and I think we've kind of hit on the most important ones. I think the takeaway there is, just recommending that people are following those proposed changes, working with industry trade groups, or even within your own organization with your advocacy folks to make sure that you understand what the implications are for your organization and you're, involved or engaged in EPA's comment process. If that's important to you to kind of submit comments to EPA, that rule will be, once it hits the Federal Register, which hasn't happened yet, but should be imminent, there'll be a 60-day comment period on that. So that's the Part 98 piece that I would encourage folks to be watching and following closely. For the other two aspects, really the issue I see with the netting provision is just understanding the logistics of how EPA is going to manage that. So we don't know if you'll be able to net across your entire company. If you have operations in different segments of the industry, so let's say you have upstream production and you have gathering facilities, will you be able to net across all of your assets, or will it just be segment by segment? Similarly, if you have assets that are operating in different basins in the US, will you be able to net across all of the basins where you have operations, or will the netting be restricted to just within the same basin? So those are some of the sort of key questions that we have that are coming to our minds that we'll be interested in seeing how EPA manages those. And then on the exemption side of things, similarly, we're just curious about, for companies that are subject to Quad OB and are in compliance, how could that compliance jeopardize their exemption under MERP? So let's say a company is following all the requirements in Quad OB, but they submit a report late, or they have some sort of record keeping type of deviation. Does that jeopardize their compliance under Quad OB and therefore their exemption under the MERP? And if so, for how long? Like, when can they get back in compliance and claim that exemption? Or is it one of those situations where once you've, missed something, then you're out, perpetually? So there's a lot of questions there just around the logistics of how that exemption is going to work.
Okay, great. Thank you for that. We'll definitely be watching closely as EPA releases more guidance on this. So moving on to from the regulatory perspective, which is our last question, I'd like to tap into your vast knowledge and experience working with organizations. So based on that experience and quickly, what are some common pain points and challenges they face when it comes to MERP compliance, and how can they effectively address these challenges?
Yeah, I don't think there's anything unique to MERP and in this space from the standpoint of, I still think the biggest challenge for most folks is just data management, data collection, records management. What we're seeing is, as there's an increasing focus on ESG performance and sustainability, whether it's from supply chain pressure or from internal board of directors or from EPA, I think the challenge is for environmental professionals and for companies to just manage this giant, mess of data. And one of the things that's really becoming apparent is that these various drivers may be requiring carbon accounting on a different basis than one another. So we're seeing many companies are wrestling with, okay, I now have 2 sets of books, or maybe 3 sets of books, one for my state reports and one for EPA greenhouse gas reporting and one for my ESG report. And how do I reconcile these and make sure they're all, transparent, accurate, auditable? And so I think that's really the biggest challenge we're seeing. And as we saw in the poll, there's still quite a few people managing their data with spreadsheets. And so it becomes very unwieldy when you're trying to collect and calculate and manage that much data. And also we're seeing more frequent, board of directors want to see updates more frequent than annual. So that just exasperates the challenge of trying to manage all of that data.
Absolutely, and those are certainly pressing challenges, but as with all challenges, they present opportunities to innovate and evolve. And the push towards digitization seems to be one promising solution. So with that, we're about out of time. So thanks everyone for joining the call today. We really appreciate it. If you'd like more information, please make sure to see Cority's booth in the lobby. And if we did not get to your questions that were asked, we will follow up shortly after the webinar. But thank you very much, and enjoy the rest of the day.